So that official news just coming in, 25 basis point cut.
So the official cash rate is now 4.1%.
Well, today the Independent Reserve Bank decided to cut the cash rate to 4.1%. This is very welcome news for millions of Australians.
Now, despite the welcome cut today, it's a long journey back to the standard of living Australians had when these interest rate increases began.
Hello, I'm Rebecca Jones. Welcome to the Bloomberg Australia podcast. This week, the Reserve Bank of Australia did exactly what everyone expected it to and finally cut its key interest rate by 25 basis points to 4.1%. Now, that was the first cut in more than 4 years. The RBA, of course, lagging behind its global peers that have been merrily slashing rates for quite some time. Today on the show, something a little different. You are going to hear from someone who was inside the room when that decision was made. RBA Deputy Governor Andrew Hauser. But before we do that, I'm delighted to welcome back Bloomberg economy reporter Swati Pandey to the podcast to help me break down Tuesday's decision. Swati, thank you for joining me.
Thank you, Beck. Happy to be with you again.
What a week it's been. Mortgage holders can finally breathe, a tiny sigh of relief, but they really shouldn't get too far ahead of themselves, at least not according to RBA Governor Michelle Bullock. Swati, you were at the press conference after the decision on Tuesday. What sort of clues about further rate cuts did Bullock drop?
Michelle Bullock was really cautious about any further interest rate cuts. She repeated and reiterated, and she was trying to drill down this message really bluntly that the RBA has cut interest rates, but it is not the start of an easing cycle. Usually an RBA rate cut is followed by another easing. We have seen back-to-back cuts or cuts that come in groups. This time it's going to be different. And just to encapsulate that, I have some quotes from her from the press conference that really drills this message down. So the first one is from her. I want to be very clear that today's decision does not imply that further rate cuts along the lines suggested by the markets are coming. So just to provide some context, markets were predicting 2 more rate cuts for 2025 in addition to the one that has already been delivered. So 3 rate cuts for the year. And Michelle Bullock was basically telling people, do not expect even 2 more rate cuts. So that was a really strong message. The other one from her was, we have to be careful not to get ahead of ourselves, and we cannot declare victory on inflation just yet. So those comment just really shows how cautious they are about inflation, how cautious they are about the economy, and they are still not 100% confident that it is time to start a proper easing cycle, one that we have seen in New Zealand, in the United States, in Canada, not happening in Australia.
It's fascinating how quickly it all moves, right, from 3 to 1, and the market, of course, adjusting their expectations of a cut accordingly. And, we were still blogging the decision on Tuesday, and there was announcements coming out from all of Australia's largest banks, very, very quick to pass on those cuts. Swati, what sort of data will they be looking at when they make the next decision? And that is whether or not to cut at the April 1st RBA meeting.
So the RBA is an inflation targeting central bank, but it has dual mandate. So inflation is not the only thing that it targets. The other thing that it looks at is the labor market, employment, jobs. So apart from inflation, which is going to be the most important figure that everybody keeps an eye out for, the RBA will also be looking at where the unemployment rate is, how employment growth in the economy is tracking, and where wages growth is. We had wages data on Wednesday, which is pointing to a slowdown in the rate of growth. However, the RBA's own forecast, which was released on Tuesday, shows that there will be an acceleration, and that there is some weight in that forecast because we are already seeing signs of unions demanding greater pay increases. If you live in Sydney, you must have experienced some sort of disruption lately with strains. And that is because unions are demanding more wage increases. And we are seeing a bit of that in some other sectors as well. There is a lot of wage increases that we have seen in public sector, in government jobs. So that is the type of wage increases that Michelle Bullock is a bit wary of, especially in an economy which is not growing very strongly. And Deputy Governor Andrew Hauser is going to be talking about that as well, because that is something that definitely was discussed inside the boardroom.
On that note, let's hear now from Andrew Hauser, the Deputy Governor of the Reserve Bank of Australia. Here he is speaking with Bloomberg's Heidi Stroud-Watts earlier today.
Joining us now is the RBA Deputy Governor Andrew Hauser, and such a rare treat to speak to you, to speak to anyone from the RBA, so we appreciate your time. I think what that introduction sort of left out is the fervour that we felt, this sort of nationwide applause and sigh of relief. Do you feel like a bit of a rock star this week?
Do you mean in terms of the Labour data?
No, in terms of the first rate cut in 4 years.
Oh, I see. Look, I mean, central bankers are probably not the people you want to invite to your rave or your dinner party, to be absolutely honest. We're paid to worry and we're paid to be serious about the economy. So I wouldn't say there was celebration in the RBA about this. We did what we always do and look at the data and try to form a view about where monetary policy should go.
Was there consternation, though? I do wonder in that room, how hard was it to get to consensus, given that there are still data points that would support a hold, perhaps in a different environment?
Well, look, it's interesting, isn't it? And I'm sure you were reporting this. The markets had formed the view that it was more or less a slam dunk, that this would be a rate cut. And the debate in the room, as Governor Michelle Bullock said earlier this week, was more balanced than that. There was, as there always is, an exchange of views about the case for a hold and the case for a cut. And as you say, there were factors on both sides. We reached clear consensus on the decision in the end. But I hope, and I think it would reassure you, and I hope it reassures markets too, that we're not sort of saying, oh, well, the answer's already there, so we follow the market and we just do what people are expecting. We look at the economics and we make a decision.
There's nothing predetermined about this particular trajectory of this easing cycle, I think, for any central bank at the moment. But it's interesting, we heard from the Treasurer saying that inflation is in the rearview mirror. With a lot of the risks, be they global tariffs and counter tariffs or election year spending, do you think that's going too far?
Well, I mean, the Treasurer can speak for himself. There's been a great deal of positive news about inflation in Australia. Just to remind you, and you know this, we adopted a somewhat different strategy to tackling the inflation spike in Australia to other countries. We raised interest rates to a level we thought that were restrictive, but we didn't raise them to the sorts of levels that other central banks had done, precisely because we wanted to protect the gains in the labour market. And as I think you've been talking about earlier, the labour data out today show that the labour market in Australia has been incredibly strong, but inflation has also come down as well. What we said in December is that we would form a view about whether we become sufficiently confident that inflation would come sustainably back to target, to the midpoint of the target, 2.5, to begin easing. We did reach that position of sufficient confidence, but this is not a done deal yet. The underlying rate of inflation is still 3.2%, which is slightly above the band. The headline rate of inflation is in the band. And so although we've removed some of the restrictiveness that we had in policy, there is still restrictiveness in the system, and we still need to see a bit more good news on inflation coming back to that midpoint.
And the jobs data was quite nuanced, right? Because even though unemployment ticked up, even though we saw more jobs than expected full-time being added, participation is still really high. The wages data this week showed, further slowing. Does that tell you that some of that robustness might start to fade in the coming months?
Which bit of it shows you that it might fade?
That we're starting to see the signs of perhaps a little bit more vulnerability in the labour market. And of course, Australia's not the only one that's kind of dealing with that scenario.
It's quite hard to see bad news in the latest employment data. They remain very strong. I think the debate about the labour market is a slightly different one, which is, although we know employment has been growing strongly, inflation has been coming down. And as you say, wage inflation has been coming down too. And so there's a very lively debate about whether that employment growth leaves us with less capacity in the labour market or a bit more. If there is a bit more, then inflation will come down more quickly than we're predicting, and that'll be good news because it would mean that we can adjust policy more rapidly. But we need to see more information on that, I think, before before we can be sure.
How does a change in immigration numbers potentially affect that, particularly with the labour market, but broader growth in general? Because we are expecting that regardless of who wins this year's election.
So I tread into issues of migration with some tentativeness as a central banker. Obviously, Australia, for long periods of time, has had a model of substantial immigration as part of its growth model and has done very well out of that. In terms of the inflationary implications for immigration, broadly speaking, our view is that it's a wash. So every person that comes into in general, people that come into the economy, they increase the labour supply, which pushes down on inflation, but they also have to purchase things, and they have to consume things, and they have to spend money, and that increases demand. And broadly speaking, you can debate the details, those two effects probably factor out, leaving inflation roughly where it would be otherwise.
I do want to get your view on the property market. I know it's not it's not an RBA topic, but it is a national obsession, of course, right?
I'm a renter, I should say. That probably immediately puts me in the same category. But
whether you're
I've got nothing at stake here.
Yeah, but it is an ongoing problem, and it is something that feeds into the affordability and the cost of living crisis. Is there a balance there? Is there a policy to sort of balance that you can see?
Well, I think one of the quite encouraging bits of news in the latest decline in inflation is that some of those metrics, whether it's dwelling costs or rents, have started to come off, inflation in those two amounts. And that was one of actually the surprises in the undershoot of inflation that we and the market both saw in those numbers. And so some cooling there. I hesitate to say that, where this is going to leave us in 2 or 3 years' time. And clearly there are major structural challenges in the Australian housing market that I'm not going to wade into. All we can do is, take as an input our best read of what's going into the housing market.
So not 2 or 3 times, but 2 or 3 years in the future. But let's look forward to April, right? If I put it to you that the monthly CPI data that you get, maybe the 2 readings beforehand, show that first quarter trim mean is going to come in under the forecast from this week, would that trigger a move?
No single piece of data will ever trigger a news. We get a lot of a cut or a move. We get a lot of data in every month from surveys, from hard data, from our liaison people that are around the country talking to businesses. And our job is to put all of that information into a hopper and form a view about the outlook for inflation. Clearly, the inflation numbers are important. As you know, there are challenges with using the monthly data in Australia because the monthly indicators, they're not even called inflation numbers, are partial reads on inflation, and we only get a full 100% read on inflation once a quarter. That causes us to aim off a little bit from the monthly numbers, but look, if they come in weak, that will obviously be important for us. And as I say, I wouldn't quite say what's not to like here, but a world in which our forecast for inflation may be being a little bit above on the basis of the market curve, if we get news on the downside of that, that's a cause for celebration.
Do you envisage a challenge where rates stay the same because there is, of course, so much caution, uncertainty, inflation continues to come down, and you get that de facto financial tightening scenario? Is that a worry?
Well, it's interesting actually because our forecast, which shows inflation stabilising slightly above the midpoint, has got some interest. Point number one is that's conditioned on the market curve, which assumes that there'll be 3 or 4 more cuts. But one of the pieces of information that the board reviewed before making its decision was an alternative version of that forecast, which looked at what would happen if we held interest rates constant, which I think is your question. And under that forecast, and we didn't publish this, but I can tell you this is what it looked like. Under that forecast, inflation didn't stop at 2.7, it undershot the midpoint. Not by a lot, but by a little bit. And that factor alone was quite an important input into the board's decision. So holding interest rates constant would have led inflation to undershoot, and that was an important part of our discussion.
And when we come back, we'll have more of our interview with Andrew Hauser, Deputy Governor of the Reserve Bank of Australia. This is the Bloomberg Australia podcast. Welcome back to the Bloomberg Australia podcast. I'm Rebecca Jones, and today you're listening to what RBA Deputy Governor Andrew Hauser had to say in his sit-down with Bloomberg News earlier today.
Where do you see the neutral rate at the moment? There's a note out this morning from CBA modelling and coming out with it being around 2.9% for the nominal neutral?
Well, there's a chart in our report, our statement on monetary policy, that shows the range of estimates of the neutral rate, and it runs from something like 1 to 4. Now, 3 percentage points of difference in such an important macroeconomic variable is pretty useless, to be honest. It's far, far too vague for us to put a great deal of weight on that. We show that chart, I think, to make 2 points. One is that it is very uncertain, and if anyone ever tells you, and I don't think you'll ever get a senior central banker to tell you, I know what neutral is going to be, and it's 2.x or whatever, it shows how uncertain it is. But what they all show as well is that we're clearly restrictive. And there has been a debate about that too. You know, can you afford to cut interest rates if you're not sure you're clearly restrictive? We are sure we're clearly restrictive, both before the rate cut and now after it as well. But I would not want to put a number on it within that range.
Okay. Do you feel that markets, investors are on the same page as what the RBA is putting out now?
Well, I'm glad no, but they never are, right? So let me clarify what I mean by that. I spent decades of my life in financial markets, and I very much value them, listening to them, talking to them, being challenged by them, because markets, as you know, are not one view. There are many views coming together to trade to get to a single outcome. And so we learn a great deal from speaking with market participants, and we learn a great deal from market prices. If you look at the interest rate curve in Australia at the moment, you will see still price several further cuts. All we were saying in our forecast was that on our judgment, if you put that rate curve into our best guess about the economy, inflation is probably going to be a little bit above target. And so we don't have the confidence that the market does that number of cuts would bring inflation sustainably down to target. But let me be clear, we could be wrong. And I know it's sort of a crime for central bankers to say we could be wrong, but I think we should be doing it more often. And in this case, if we're wrong and the labour market shows it has more capacity and inflation comes through weaker, then policy will respond. So I don't think, I'm not abashed about that point. Clearly the market currently thinks that there will be greater capacity in the market. That's not our central view, but it might be right. And if it is, we'll learn from it.
To that point, Governor Bullock says that she's more of a glass half full person, that you're more of a glass half empty person. So
she said that, did she?
Yes, she did, and quite recently. And I guess my question to you, as I guess, you know, perhaps a resident pessimist, if that's how she's characterising you, what do you see as the biggest risks facing the economy?
I'll tell you why she said that, actually, because she was given, you may know this, by Phil Lowe when they handed over a cup that I think was his, which said glass half full, and I thought it would be rather funny to get a cup that said glass half empty. She didn't actually think it was very funny, so I'm not quite sure about that. But anyway, in terms of risk, look, I mean, number one, I'm going to be boring, but I'm going to say it anyway. Our focus is still rigorously on inflation. There are risks in both directions to inflation. We spent most of the interview talking about that. We're not going to somehow start worrying about other risks in preference to that. That's our number one focus. We talked about the uncertainties around the labour market and the possibility that there is greater capacity. That would be a good risk to have if it happens. We haven't talked yet, I guess, about the global economy, and perhaps that's where you're going. Obviously, things are changing, and I'm sure you spend a lot of time talking about this on your show. Anyone who tells you they know how this is all going to shake down in the long run is wrong, right? We're all learning. Things are moving very quickly. I think one of the important points I'd say is actually that very uncertainty about trade policy and about outcomes in general, globally, not exclusively in Australia, may itself have an effect on activity in Australia. So if you're a firm or if you're a household planning to make an expenditure that in some way depends on a certain outcome in the global economy, and you know that who knows what's going to happen in the next period, you might just wait. Now, waiting is very sensible for an individual, but it could be really bad news for the economy. So I think for me personally, one of the factors in the decision this week was actually a sense that, look, maybe that pervasive uncertainty itself may have some short-term depressing effect on activity. If you want to think about how the various initiatives that are being mooted debated around tariffs and non-tariff trade policy are going to affect Australia. There's a huge range of outcomes, really huge. How big are the tariffs going to be? What are they going to be faced on? Will there be retaliation? Will it be in the main economies that we trade with, or will it not be? You plug those various uncertainties into a model and you can get almost any outcome. It's not good news for Australia if there's a widespread depression in global activity. That's not what the financial markets currently expect to happen. But Australia has thrived when the global economy has thrived, and it's struggled when it hasn't. So we are very reliant on continued good global activity. The implications for inflation are less clear. Normally, if you impair the supply side of the economy, you'd expect inflation to rise. However, if it cuts demand, inflation may fall. So although I think it's pretty clear that, tariffs, if they push through and they have a material effect on global activity, will probably reduce activity in Australia, its impact on inflation is less clear. So, everyone is crunching through numbers. We have a section in our latest report that talks about various scenarios. But the truth at the moment is you pay your money or you take your choice. We are waiting to see how this evolves.
Is it more of a broad global risk for you, or is there still specific risk when it comes to China? Because, traditionally Australia's growth has relied so much on the strength of China. We know that they're moving away from industrial production from the property market. That's not going to improve meaningfully anytime soon. Does that have strong implications, or are we well diversified?
It could do. I was sort of talking about this with your colleague earlier. I think if you look at Australia's long history, Australia has actually been incredibly effective at responding to the changing shape of demand in the global economy. You talk about traditionally our links with China. Of course, that's true in recent years. But if you go back 20 years, 30 years, 50 years, 100 years, Australia has actually specialised in a whole series of different activities and done very well out of it based on where the demand in the global economy is. If the demand in the global economy moves on from steel being sold to China, then Australia will need to think about adjusting in that respect. And as I say, I have some optimism, actually, this is not glass half empty, that Australia will respond to that in due course. But look, we are keeping a very close eye on Chinese activity, as I know you are too. It's been challenging in China in recent years with the demand growth and the adjustment in the property sector. One thing I would say is I think steel production and iron ore exports, therefore, from Australia have held up probably surprisingly well. 2 or 3 years ago, you could see all sorts of people drawing charts with big lines going down. Peak steel's far behind us. Actually, demand for steel has held up. And we have people in China who are based in the Australian embassy there and go around and talk to a very wide range of Chinese businesses and thinkers and academics and policymakers. And China's been quite clever about diversifying itself in its use of steel away from the traditional uses and towards, data centres, for example. Let's suppose we all go AI. Well, you're going to need a great deal more data centres. That still needs steel. So the death of steel is probably, foretold a little bit too early sometime. But look, if we have to adjust, we'll have to adjust.
And thank you for listening to the Bloomberg Australia podcast. You can catch our full interview with RBA Deputy Governor Andrew Hauser on Bloomberg.com. You've been with me, Rebecca Jones, and Swati Pandey, Bloomberg economy reporter, bringing you this episode from the traditional lands of the Wurundjeri and Gadigal people of the Kulin and Eora Nation. This episode was produced by Paul Allen and edited by Chris Burke and Ainsley Chandler. Don't forget to follow and review our show wherever you get your podcasts and sign up for Bloomberg's free daily newsletter, Australia Briefing. Go to Bloomberg.com to subscribe.